If you're treating your health savings account like just another medical spending account, you could be leaving thousands of dollars on the table. What if your HSA could actually double as a tax-free investment account for your future? In this video, I'll show you how to use your HSA strategically so you can lower your taxes today, grow your money over time, and build a powerful cushion for future healthcare costs. Max out your HSA contributions each year to fully capture its triple tax advantage. A health savings account is one of the few accounts in the U.S. tax code that offers 3 separate tax benefits at once. Your contributions are tax-deductible, your investments grow tax-free, and withdrawals for qualified medical expenses are also tax-free. For 2026, contribution limits are set annually by the IRS, and if you are eligible, you should aim to contribute the full amount whenever possible. For example, if you contribute $4,000 and you are in the 24% federal tax bracket, that alone can reduce your federal tax bill by about $960, not including potential state tax savings. If your employer offers payroll deductions, those contributions may also avoid FICA taxes, which adds another 7.65% in savings. To take advantage of this, set up automatic contributions throughout the year so you do not miss the limit. If your cash flow is tight, prioritize at least contributing enough to cover your expected annual medical costs, then build toward the maximum over time. Treat your HSA like a long-term financial tool rather than just a spending account, and you will unlock its full tax efficiency. Invest your HSA funds instead of leaving them in cash to grow long-term wealth. Many people treat their HSA like a checking account, but once your balance exceeds a certain threshold, often around $1,000 or $2,000 depending on the provider, you can invest those funds in mutual funds, ETFs, or similar options. Leaving $5,000 sitting in cash earning 0.5% interest might generate just $25 per year, but investing that same amount with a 7% annual return could grow to nearly $20,000 over 20 years. Because all that growth is tax-free when used for qualified medical expenses, it is more powerful than even a Roth IRA for healthcare costs. A practical strategy is to keep a small cash buffer for near-term expenses, such as $1,000, and invest the rest in a diversified portfolio aligned with your time horizon. Be mindful of account fees and investment expense ratios, as high costs can eat into your returns. Over time, this approach can turn your HSA into a significant asset for future healthcare needs. Pay for current medical expenses out of pocket and let your HSA balance grow. One of the most powerful and often overlooked strategies is to avoid using your HSA for small or routine expenses today if you can afford to pay them from your regular cash flow. For example, if you have a $500 doctor bill and you can pay it with your checking account, leaving that $500 invested in your HSA allows it to continue compounding tax-free. Over 25 years at a 7% return, that $500 could grow to over $2,700. The IRS allows you to reimburse yourself for qualified medical expenses at any time in the future, as long as the expense occurred after you opened the HSA and you kept proper documentation. This means you can effectively create a tax-free reimbursement pool for yourself later in life. The key is record keeping. Save receipts digitally and track them carefully so you can justify withdrawals if needed. This strategy requires discipline, but it transforms your HSA from a short-term spending account into a long-term investment vehicle. Keep detailed records of medical expenses to enable tax-free reimbursements in the future. The IRS does not require you to reimburse yourself from your HSA in the same year you incur a medical expense, but you must be able to prove that the expense was qualified and incurred after your HSA was established. This creates a unique opportunity to delay reimbursements and allow your funds to grow, but it also puts responsibility on you to maintain proper documentation. For instance, if you pay $2,000 out of pocket for dental work today and keep a record, you could reimburse yourself years later, completely tax-free, even after that money has grown through investments. Best practice is to store receipts digitally, include explanations of benefits, and maintain a running spreadsheet of unreimbursed expenses. This protects you in the event of an IRS audit and ensures you do not lose track of eligible reimbursements. Without proper records, you risk turning a tax-free withdrawal into a taxable distribution plus a 20% penalty if you are under age 65. So organization is essential. Use your HSA strategically in retirement to cover healthcare costs and reduce overall tax burden. Healthcare is one of the largest expenses retirees face, with estimates often exceeding $300,000 for a couple over their lifetime. Your HSA can serve as a dedicated, tax-efficient way to cover these costs. After age 65, you can withdraw HSA funds for non-medical expenses without the 20% penalty, although you will still owe ordinary income tax, similar to a traditional IRA. However, if you use the funds for qualified medical expenses, including Medicare premiums, long-term care insurance up to IRS limits, and out-of-pocket costs, the withdrawals remain completely tax-free. This gives you flexibility to manage your taxable income in retirement. For example, instead of withdrawing $10,000 from a traditional IRA and increasing your tax bill, you could use your HSA to cover medical expenses tax-free, preserving your other accounts. Planning ahead by building a sizable HSA balance allows you to reduce required taxable withdrawals from other retirement accounts and better control your tax bracket later in life.